It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today is Mayor Michael Becker.
Hey, Paul.
Hello, Your Honor.
How's it going?
It's going great. Thanks for joining us in your Ask Mike Mondays. Mike, who is the owner with his group over 5,000 apartment units. That's a lot of people in your building.
A lot of heads and beds. That's right.
A lot of heads and beds. Would you think that's, 10,000 people?
Yeah, I think all the deals that we've done is, it's probably usually you have about 2 on average in an apartment complex per unit. So, probably somewhere in that range.
Mayor, Mr. Becker has over $100 million worth of equity that investors have invested with Michael to buy multifamily properties. So he's a former banker for one of the largest banks in the United States and made the transition from loaning money to owning apartments and being the mayor. So we're honored for the mayor to be with us today. So thank you, Mr. Mayor.
All right. Glad to be here.
So the question that came in today is, Michael, what's your opinion of HUD financing for apartment buildings?
It's good if it fits your situation, but it's certainly a difficult process to get there. So we're actually in the process right now of assuming a HUD loan and getting what's called a TPA, a transfer of physical assets. So that's some new jargon to me that I learned through this whole process. Typically, when you go in and doing a new HUD loan, it'll take upwards somewhere between 6 to 9 months to get done. When you do a loan assumption of one, it's typically 3 to 4 months to get done. Once you fill this paper out, it's amazing to go through this process that we probably did. I don't know, Paul, maybe 4 to 5 banker boxes full of paper to do 4 forms that get filled out and submit to them. Wow. And it's all the supporting documents that they want. One of the things that we got a good recommendation on is you make sure that you get a very competent and experienced HUD attorney, someone that does this for a living all day. And then they really kind of on the TPA process, the HUD attorney runs the show, which is pretty amazing. It's not so much the lender that we're assuming the mortgage from that's servicing the HUD loan. It's really more the lawyer that's preparing all this stuff. So that's money well spent that we hired this guy out of South Carolina of all places to do a loan in Fort Worth, Texas for us. So it's been interesting. But when at the end of the day, when we assume this mortgage, we're getting a loan that we're maybe about a little bit less than 2 years into, that's got, a 35-year amortization that's fixed rate at 3.25% for 35 years. So that's pretty unbelievable. With the HUD loan, too, one thing to point out that they do have what they call mortgage insurance. So MIP, mortgage insurance protection, and that's about 60 basis points of loan. So you kind of add that to the rate. We got about a 3.85 all-in rate for 35 years, which is still pretty unbelievable because today a Fannie Mae loan, Paul, what's about 4.5 to 4.75 for a 10-year term?
Yeah, somewhere in there. But why did you guys have to assume the loan? Why couldn't that seller just pay it off?
Well, you get a Fannie Mae loan, a Freddie Mac loan. You hear a term called yield maintenance, or if you get some of these other sub-Freddies and all the CMBS have defeasance. So there's essentially like a formula that they make sure that the note holder, the mortgagor, will have a consistent yield. And if you pay the loan off, you have to kind of give them what the difference with the current market rates, and then how much time's left. You got to pay a big, large prepayment penalty.
You got to make them whole.
Make them whole, basically. So on the HUD loan, they have declining prepay. So it's like a 10 to 1 declining prepay. So it steps down 1% every year. So we're in this deal, we're about 8% on the prepay right now. So it would have been 8% of the loan if we had to prepay it today. So it's pretty prohibitive from just a cost standpoint, economics of it. So we're coming in, we're about 70% or so levered on the deal. So it's not too far off what we would get in the market, maybe 5%, but we saved the 8 points on the prepay. So it just really is better to get a lower basis than prepaying it. It just wouldn't have made sense if we prepaid it. So plus, honestly, kind of selfishly, we just wanted to do a HUD loan. We never had done one, and you can't do it on acquisition. So we wanted to kind of get into it and see if this makes some sense, because we have some other deals that we own that we potentially could refinance one day. And if the HUD loan works, and we can, potentially refinance the deals that we own into a HUD loan. The HUDs are much more palatable to do if you already own the deal and it's a refinance, because you have the luxury of having 6 months. If you're doing a loan purchase, this is not practical, because no buyer is going to let you sit around for 6 months while you go place a HUD loan on it.
One of the things that I think some of the drawbacks are pretty much maybe 2 things. One, you need audited financial statements. on a yearly basis, and Fannie Mae, Freddie Mac, and the bank does not need audited. They just need a regular P&L that was based on your accountant or you building it, but they really need a CPA to come in and do audited financials. Second part is you can only push out distributions twice a year. So if you have investors that invested with you, instead of trying to do monthly or quarterly, you got to just do it once every 6 months or so, or whatever. Again, if they have the ability to pull the cash out. If you don't have the ability to pull the cash out for distributions, HUD wants you to keep that money in there for a rainy day. So it's not a bad deal because maybe right now you have a lower interest rate than you have a Fannie Mae or Freddie Mac. It is sometimes cost prohibitive. On smaller transactions, you probably want to do a HUD loan. If you're thinking about this property being a legacy asset that you're going to hold for a long period of time, because this is an amortizing loan over 35 years. The term's 35, the amortization 35. It's a permanent loan. So you don't have a bullet coming at you at the end of the 10th or the 12th year. And if you're thinking about if this is a property that your family's going to own, it's going to be part of your legacy. It's something that, to kind of like Ron Popeil, when he had that chicken rotisserie, you kind of set it and you forget it. So
timely pop culture reference there, Paul. That's good. So yeah, and one of the other things too I didn't mention is the replacement reserves. What Paul mentioned is a 35-year permanent loan. So the engineer that HUD hires to go out and inspect your property is going to look at a longer replacement schedule than what you normally would have on a Fannie Mae or Freddie Mac. So most of the Fannie Mae and Freddie Mac loans, you'll get $250, anywhere from $200 to $300 a unit is pretty typical to have for replacement reserves. This one we're assuming is a 2008 built property, and they have $400 a unit a year. And if it was, probably a little bit older asset, like an 80s asset, it might be, $500 a unit a year.
Right.
So really, they force you to put the money aside because they know in 10 years from now you have to redo the parking lot.
So permanent loans are a little bit different, just like what Michael was saying, is because they know over a period of time that this loan is going to be on the books for 35 years, that you have to replace doors and windows and hot water heaters. And so your replacement reserve is a lot higher because you're kind of replacing pieces of the car, one piece at a time, versus a Fannie Mae loan where the loan's only for like 10 or 12 years. And that's why your replacement reserve is a little bit lower, because they know that deal is going to turn over. And the next group coming in is going to update the property hopefully at that period of time when they get a property condition assessment report for the new buyer comes out and kind of figures out what the problems are of the property, the immediate repairs that need to be done. So it's a difference between having kind of a permanent loan or a Fannie Mae, which is kind of a semi-permanent loan, and the replacement reserves. Because the FHA can go up to, say, $1,000 a door annually for replacement reserves, because, again, they're taking that this is a permanent loan and you're going to have this loan on their books for 35 years. Anything more to add to that, Mike?
No, it's been an interesting process. So hopefully we'll be somewhere between 3 to 4 months all in on this process, and we'll get this thing closed. Hopefully by the time this podcast is released, we will have closed on it. But it's been a good loan, so we're looking forward to getting that low interest rate and longer amortization on it.
One thing people sometimes think about FHA or HUD loans is that it's only for affordable housing, or Section 8, or something that has to do with the government for reporting for lower income people. Is there any lower income people in this?
Yeah, no, this is a complete market rate deal, meaning that we can lease it to whoever we want. There's no affordability component to it.
So that's good too. So just FYI, in the back of your mind, again, FHA loans do take a lot longer than Fannie Mae loans. So sometimes people use them. They would do a bridge loan. First, acquire the property, and then apply for an FHA loan at the beginning, and then pay off the bridge loan 6 to 9 months down the road.
Yeah, cool thing too is that they'll go up to 85% or 87%. It was 85%, Paul, on the refi?
Correct.
Yeah, so you get a little bit more proceeds with the longer amortization. So like if you're, this typically doesn't work as well in like I said, an acquisition, but if you guys want to own it and it's your own money, legacy asset, a little larger asset, certainly I reach out to Paul or one of the guys here at Old Capital, and we can talk through all the nuances of the deal versus a regular conventional Fannie Mae or Freddie Mac loan.
Fantastic. What else is going on in your world?
That's really it. We appreciate everyone listening to the podcast. If you guys want to find out more information about Old Capital, please just go to www.oldcapitalpodcast.com. On there, you can find the Multifamily Finance 101, kind of the white paper on how these deals get put together, as well as a sample due diligence checklist. That's the one that I put put together that we use when we're submitting letters of intent out there, that this the diligence request that we ask from a buyer. So all the material that we typically ask for when we're trying to underwrite a deal.
Yeah, that 15-page white paper is really invaluable. It's for somebody that really has never done an apartment transaction and is trying to get into the business. That just kind of gives you the basics of understanding and some just typical jargon that you're going to be looking for. So it's something that Michael and I wrote that I thought you wanted to have in your hands. Also, too, is that if you have a chance, go onto iTunes or Stitcher and leave us a 5-star rating. We would appreciate that. And then if you have a nerd apartment investor that that you think that would appreciate listening to our podcast, refer a friend. So we would appreciate if you are part of a REIA or a meetup group that talks about apartments. Make sure you mention the Old Capital Podcast to get them educated too, so you know exactly what's going on and they can help you. So that was Michael Becker. I'm Paul Peebles. Have a great day.